Well, he cut his 2026 growth forecast to 5.2% on the back of a confidence shock from the flood control scandal, softer public infra spending, and wary consumers. With us for more is the research head and chief economist of Security Bank, Angelo Taningco. It's good having you back here, Angelo. Welcome to the program.
Thank you, Kathy.
Okay, so where do you stand? You were standing at the middle of the pack. I saw in the last Business World poll, when the fourth quarter and full year GDP forecast came out, you were at 4.2 to 4.8 respectively. Now you're at 5.2. So how did you get there with that forecast of 5.2 for the full year?
After seeing the Philippine GDP being the second worst performer in ASEAN, next to Thailand last year, we think that there is now room for some confidence-driven growth recovery this year. We think that the GDP growth can top 5%, albeit at a gradual pace in terms of sequential uptick. And we saw capital formation, for example, in negative territory last year, specifically in the fourth quarter because of the halt in construction. We think construction will resume. Capital formation, such as private sector spend, will also recover as early as the first quarter. In fact, we saw the manufacturing PMI bouncing back at 52.9, and that is the best performance for PMI readings in the region.
Now, you made a mention of confidence-led recovery, and a lot of that confidence really is in the private sector. What do you think is going to have to change to make the private sector take the lead in this recovery, if public infra isn't at the moment?
Yes, after seeing that the corruption scandal heightened in terms of its impact on market sentiment late last year, we think that we have seen already the worst. So moving ahead, the private sector is now back at its plans of expanding, though they are cautiously optimistic. So we have talked to several of them from the manufacturing side to the supply chain industries, and we have seen a upbeat tone coming from several companies.
When you say several and that upbeat tone, where is that coming from, in which sectors, and which ones are still showing a little bit more caution?
Well, manufacturing is one, and that is also indicated in the renewal of orders, the order demand, and the production side.
Those who also export.
Yes. The export market is still favorable. In fact, the export performance has beaten expectations last year. We think that can continue to be the case for this year. We also see hope from the tourism side. It was down last year, but because we are hosting ASEAN, that can bode well for tourist arrivals, also for the MICE sector, that can reinvigorate, hotel and accommodation industries. And likewise, consumers continue to spend still. We have seen more consumers now wanting to borrow in order to sustain their spending plans. And therefore, that also would be a big contribution to
Is that right? I mean, borrow not to pay their debt unpaid from last year. Are you getting more anecdotal evidence that it's to spend and sustain their plans this year?
Yes. Well, also you still have the consumer preference for experience. That will remain. Likewise, we have seen also the debt repayments. Still not at a heavy burden because interest rates are relatively low, and it's going to be lower, especially with our view for the BSP to cut the policy rate this coming Thursday by 25 basis points.
Okay, but we've just talked about the growth side. What about reining in inflation? Because really, that's the mission of the Bangko Sentral, is really to rein in inflation. And while growth is slowing, inflation is getting a little faster.
Yes,
and that could be a concern for the Bangko Sentral on Thursday, wouldn't it? I mean, in their discussions when the Monetary Board does convene on Thursday.
That conformed to our expectation of a sequential uptick on inflation because partly low base effects. Last year, it was very low, 1.7% on average. First quarter, we think it can top 2%. We have seen the January inflation on a slight upside surprise at 2%. In the second and third quarter, we think inflation can top 3%. However, the 2 to 4% range will still be intact in our view. So our full-year average inflation of 3.1% is still deemed to be manageable. And hence, we think that there is one more rate cut down the road. After that, because of the lag effects of rate cuts, and that will be a total of 225 basis points, assuming a Thursday cut, then we think that the BSP could pause in order to observe the demand-side effects of the rate cuts that have been delivered in the past 2 years. In fact, core inflation has already picked up in the January print. So that seems to be going to be closely watched by the BSP.
Exactly to your point, core inflation has picked up. Could there be a chance for a pause this Thursday?
Well, we think it's very little chance for a pause because in terms of the timing, the BSP, if it wants to cut further, it may want to do so as early as Thursday instead of a few months after when inflation is already accelerating.
Well, what do you make of the messaging so far from the governor? Because the last time we heard from him was last week, and he made a mention that he'd be more concerned about inflation punching up above 3% than if it were to fall below 3%. And also going back a few months ago at the end of the year with him saying, I'm close to the end of cutting.
Yeah, so we are also of that view that we are near the tail end of the monetary easing cycle. And with inflation touching 3% in the middle of the year, then we think that we have to have one rate cut more so that then we pause momentarily so that when inflation picks up further, then we send to the markets the signal that we are already at a pause. And that will bode well for, say, the local currency.
But would it bode well for the interest rate differentials? I mean, the Fed kept rates on hold, and there will be a change in the leadership by May. That would narrow the interest rate differentials and might concern the Bangko Sentral, wouldn't you think?
Well, at a record low 50 basis points, we have seen that interest rate differential late last year. And even though the BSP is not in lockstep with the Fed for the past months, that has not really exerted sharp depreciation pressure on the peso. The depreciation pressure was more on the political factor in the second half. But this year, the outlook on the US dollar itself is bearish. And therefore, the market is expecting more Fed rate cuts, particularly after we saw the weak CPI inflation print last Friday. And the new Fed chair, Kevin Warsh, who we think will be supportive of Trump's rate cuts, would then deliver a cut, we believe, as early as June, and then another as early as September. And therefore, the rates differential will widen by year-end at 100 basis points.
All right, we'll keep an eye on 25 bips as you're expecting with the rest of the poll that we've conducted on
Yes.
Business World. Thank you, Angelo.
Thank you,
Much
Kathy.
appreciate your insights. Angelo Taningco of Security Bank.